Welcome to Trading Day the Open on Your Money.
Let's bring in Ben Brun from Australian Stock Report for a bit more on what to be watching this morning. Ben, it's a pleasure to have you on board and thank you so much for joining us this morning. Look, a bit of a mixed lead from Wall Street. We were expecting some gains out of the gates this morning, but we are, of course, in a holiday shortened week. So I imagine any gains that we might see today will probably be built on fairly light volumes.
I would suggest that will be the case, definitely, Leanne. Great to be back with you. Yeah, look, the market has been in a reasonably optimistic mood for the last little while, but certainly last week the banks were definitely back in vogue. And of course, you know, looking at sort of seasonal factors, we're going into their earnings, and historically they do have a little bit of a run going into earnings and of course paying dividends as well. So, but I think that there might be a little bit of the form from commodity-based stocks today, and just listening to the opening in terms of what you said there with what BHP, how they've come out of the blocks, it might be the miners that are back in focus today, in particular the energy sector. I would anticipate a little bit of strength happening there. And, you know, this is despite the fact that we've got a lot of headwinds conceivably facing our market at the moment. Of course, there's still no resolution of the US-China trade war. That goes on and on and on, seemingly without end. And of course our own election here in Australia, which is very much a focal point and a big uncertainty for our domestic market. So, you know, the said strength, especially from last week and the last month or so, as we climb our way towards 6,300 points, really does come against the grain as far as I'm concerned. And you know, having a look at statistics, our senior advisor at the ASR, Vikram Brun, he's a big man. He's a big man in statistics as well, and he was pointing to the fact that, of course, sell in May and go away. That's a very, very big and clear and present danger, I think, for our markets this year. But that sort of goes into June as well. Historically speaking, June isn't a good month either. But July, we see a really, really nice bounce back. So we've certainly got that in mind, because we're still very, very cautious about the markets, especially up around these levels. I'm just wondering what catalyst we need to propel us significantly higher from here.
Yeah.
Albeit, you know, we've had central banks have had our backs for the longest time. Are we relying on them again, really? I mean, you know, the economic data really, to my mind, doesn't warrant the levels that we're finding ourselves at the moment. Of course, we've got US earnings season as well. That's a huge factor. Quarterly earning production per season here in Australia as well. So, you know, but we want to be backed up by some solid economic data, and that's been sadly lacking at the moment. I just don't know how much the US-China trade war situation is playing a part there. Hopefully that is playing a pretty big role. And once we put this to bed, and I've been waiting for it for a very long time, but if we can get it over the line, hopefully we can see some improving economic data, and that will make us a lot more confident in terms of buying some of these cyclical names, and that's where we're really taking profits, at least off the table at these levels.
Right, so seasonally weak period we are heading into, as you say, not to mention election uncertainty as well, which, you know, there's been a lot of comments that tends to rock the boat a little bit. So against the backdrop of those headwinds that you talk about, and you probably answered my question already, but I was just wondering what you do in this kind of environment. I mean, you look at the mining stocks, which have had a phenomenal run. You just wonder how much longer that can last. You look at the financial stocks with dividend cuts at play, with a reduction in interest rates, as you talk about. Maybe they won't see any outperformance. So where do you actually go in this kind of environment? Do you take profits off the table and then just sit on the cash and wait for those opportunities to sort of reignite themselves?
Certainly we've got a lot of cash in client portfolios at the moment. That was intriguing. I mean, you mentioned the potential for a dividend cut, and I think it was Bell Potter said something this morning about the expectations for a cut in dividend at National Australia Bank. If that plays through, that is not a positive by any means. And to answer your question, look, we're at least 40% in cash at the moment and just waiting for those opportunities, the growth opportunities. I mean, that's what really gets your blood running in this market, are those the growth names, the exciting names. If we are in the market, the portfolios we've structured for clients are very, very defensive at the moment, ideally with monopoly assets. Just a couple of names off the top. I mean, Sydney Airports might be one that clients could look at. Spark New Zealand is another. Both have monopoly assets, both very defensive in terms of their earnings, in terms of their earnings structure. And they pay really, really good yields, albeit you don't get the franking credits, but that might be a reality we all have to get used to if, you know, obviously if Labor gets their way and they get into power. So, yeah, very defensive, plenty of cash on the sidelines, but we do have a little bit, say, 10 maybe at the outside, just depending on risk, a client's risk appetite. Perhaps 20% geared to growth names. But, a lot of those have had phenomenal runs and they're sitting on pretty big profits at the moment in most of those names as well.
Ben, I'm really interested in your thoughts on the healthcare stocks. Today, it is the only sector that seems to be in negative territory right now. I mean, it's not a big move, fair to say, but it's down about 17 odd points. I was noting the end of last week, there was a lot of weakness as well. Even just during the Friday session, I think it fell over 1% or so. So there's been a fair bit of weakness in a lot of those healthcare names. With them remaining under pressure, your thoughts on some of those stocks and whether you think that there's any bargains perhaps that have presented themselves?
Yeah, just having a look at some of those names, they look under pressure once again, with the exception of Cochlear. Look, the names that we like, or one name that we continue to like, and it's personally speaking at least probably my favourite stock on the board, is CSL, and we always look for any continued weakness in that name. Now, the effects, obviously, they're emanating out of the US with this Medicare for All policy that's been flagged by the Democrats in the White House. Now, that could be an uncertainty that plays out, in particular for medical insurers, I think, more than any. I mean, some of those have reported earnings in the US that have done really, really well. So it's more of a sentiment thing at the moment. And it could continue to plague the sector for, well, potentially out until the next election, so 2020. But we do look for weakness. I mean, a couple of names that we do like in the sector, CSL and NUF.AX. If you're really shopping for deep value, then we don't mind Main Pharma. But of course, you're just leveraged a little bit into a late night Donald Trump tweet against the pharmaceuticals over in the US. And if he does that, you see Main Pharma sometimes drop by 5 or 10% the next day. So look, we do look for these kind of opportunities. As I said, CSL, even if these levels, if a client buys it and sticks it in the bottom drawer and forgets about it for 5 years, usually you're very, very happy, when you pull open that bottom drawer in 5 years' time. And CSL, who knows, they could be looking at another stock split if they see sustained time above $200 a share, maybe even getting towards $250 a share. So look, healthcare names are going to remain under pressure in this session, I would anticipate, and probably just for the next little while there needs to be some selling pressure, I guess, exerted onto the stocks, or some profit taking, I should say. But that is only going to represent good opportunities. As I said, NUF.AX is an absolute, that is a great stock. Another Australian success story in the making. And CSL, I mean, that is the Australian success story of the last 20 years or so. So we always look for opportunities, price weakness, which we're getting there. So probably looking to pick up a bargain there.
Yeah, as you say, it's one of those that you tend to wait for a little bit of weakness to creep in, you get in and then you just stick with it, right? You hold it for the long term. It's such a solid company. I mean, pays a pretty good dividend as well. So kind of very much a buy and hold sort of strategy that you would take with CSL, right?
Yeah, definitely. So not so much for the dividend, more on the growth side. Definitely for the growth side. So that 20% that I was talking about having in terms of structuring clients' portfolios for growth, most of the clients that I'm speaking to at least have some holding in CSL. It's probably just a hold and really never sell unless you want to buy a house or you need the cash for some reason.
All right, excellent. So watching CSL, it's hovering just under $190 at the moment, but off about 0.5%. Ben, let's talk about another one. It's actually a new buy of yours at Australian Stock Report, and that is Nufarm. I mean, certainly one that has also faced its challenges, one of those that's leveraged to, the agricultural sector, drought conditions. It has been under a lot of pressure, certainly well off those highs that we saw in May last year. I think it was close to $9.50. Hovering here at about $5.40. Why do you see this as a good opportunity?
Well, as we've all been saying at the Australian Stock Report, this is the buy straw hats in winter strategy. So you're buying a very, very cheap stock here, and look at that, it's down around 50% since June last year. So you're getting a good bargain, and it's a 1 in 100 year event in terms of the drought that we're seeing in Australia. So that's not going to last forever, and of course farmers still need to protect their crops, and they've also got plant-based omega-3. They're waiting on regulatory approval on that, which would give them first mover advantage, which would add significant levels of EBIT to their balance sheet for the next, for the foreseeable future, provided, of course, they get regulatory approval, which we are anticipating. So we like this one. We like the ag space. As I said, the drought has really put paid to their earnings in the last 6 months or so, but they are a global business. There's a little bit of uncertainty in terms of a legal case going on at the moment, but we've run the numbers on that. We don't think it's going to impact Nufarm at any time. So that, you know, we're looking at it from a bargain perspective, as I said, on a PE around 10 times. That's the buy straw hats in winter philosophy. So we've got that with an eye to the longer term. Obviously, we're not expecting to make profits on it in the short term. In fact, you know, if the momentum is to continue to the downside, we might have to take a short hit in the very foreseeable future, but it's sort of one step backwards to make 4 or 5 steps significantly going forward in the not too distant future.
All right, fantastic. Ben, we'll keep a close eye on Nufarm, off about 1.4% there today at $5.38 right now. Look, an absolute pleasure to have you back on the program. It's good to see you there, and we'll look forward to talking again soon. Thank you so much.
Thanks, Leanne.
Ben Brun there from Australian Stock Report.